All right, so let's look at the examples and liquidations. Now guys, the idea behind these examples which I've done here is I've done it deliberately so it builds up. So 1.1 is very simple, then 1.2 adds a little bit to it, 1.3 adds a little bit more, etc. And I want you to work through all of them carefully. Okay, I'm going to explain a lot as I'm going along, so please make sure that you do follow this. So this gives us the balance sheet or statement of financial position of XP2Y Limited on the 31st of December 20X8. It said there was capital of 5 million, capital profits of 2 million, revenue profits of 1.5 million, a shareholder's loan, and some cash. Okay, so that's the first thing. Now, you need to understand what your objective here is. Our objective here, during a liquidation, is to dispose of all the assets, calculate the final taxable income, and pay our outstanding credits. That's the first part of our question that we need to be aware of. Okay, that is what we are trying to achieve there. How are we going to do that? We are going to do that by performing this calculation on our retained income. Opening balance plus accounting profit before tax, less our taxes payable, gives us the closing balance. And that closing balance, that is what gets paid out. Now, first thing that you need to see is that they give us, here's a liability, here's an asset. And all of this over here is equity. We are concerned with the equity portion of it. The rest of it will all balance out. It must. That's how statements of financial positions work and the double entry system. Now, the next thing I want you to see is, you'll see I've got here capital profits and revenue profits. Now that's a bit strange. What is that? The reason I put this in is this is something that you see very often in questions, and that's why I wanted to include it. That's retained earnings. And what they've tried to do, and what they try to do in exams, is to tell you that this is the profit that you made from selling assets in the past, and this is the profit that you make from, normal revenue. Guys, it doesn't matter. It's just retained earnings. Capital profit and revenue profits are the same. They're taxable if you pay them out. At the time when you sold it, there might have been capital gains tax, all those things, but that doesn't apply now. I want you to understand it's just retained earnings. Okay, so capital number 1 says the capital amount represents the amount that was received for the issue of shares. There has never been a capitalization issue. So that means that number 1 is contributed tax capital. This over here is retained earnings. Now, this is 31 December 20X8. They say the only shareholder is a South African resident. The shareholder lent 650,000 rands to the company 6 years ago. That's what we see there. The company was placed into liquidation on the 2nd of January 20X9. Make sure you see it's after that date. And all distributions were made before the 28th of February. The shareholder acquired the shares 10 years ago from a third party for 6 million rands. So that's the base cost for shares. Now, broken it down to a lot of things. 1. Calculate the amount that will be distributed to the shareholders. Clearly indicate what part of the amount is a dividend and what part is contributed tax capital. Now, we're going to follow this format here. We split capital, contributed tax capital, and the dividends reserve subject to dividends tax. Opening balance plus accounting profit less tax liability gives us the amounts for distribution. Okay, so contributed tax capital and dividends. So remember guys, what we're basically doing here is we are doing one big retained earnings calculation. Okay, so we start with the opening balance. Don't want you to memorize this format, but you all know how to calculate retained earnings. Opening balance plus profit less taxes, so your net profit before tax. Right. So the opening balance is the balance on the 31st of December. So 5 million is contributed tax capital. Then we have our capital and our revenue profits or reserves of 2 million and 1.5 million. Okay, so I just want to show you 2 million and 1.5 million. And this opening balance over here is now just for the capital. So this gives us the total opening balances of 5 million rands and 3.5 million. So this is our opening balances. Then we have our accounting profit. Now guys, in this case it's a dormant company. If you look at it, there's just cash. What happened for accounting here? Nothing. Right? Less our tax liability to source. Nothing again, because nothing happened there. Okay, so this is a very simple one. Gives us 5 million rands and 3.5 million rands. So closing balance slash the amount available for distribution. Okay, now calculate the dividends tax payable if the shareholder is a natural person. So what I want you to just see is you look at this amount over here, that's the dividend balance. So times 20% equals 700,000 rands. That's the dividends tax. What is the dividends tax? Number 3, if the shareholder is a South African company, then there is no dividends tax because it's a South African company. Remember that rule. All right. 4, what is the taxable income of the shareholder if the shareholder is a natural person? Okay, so CGT column, rands column. Make sure you see now. So what if this person is a natural, the shareholder is a natural person, I'm just going to remind you, it's the same situation. There would have now been 700,000 rands dividends tax. Okay. So what does the shareholder receive from the company? The shareholder receives his or her balance of the closing balance. How much is the shareholder entitled to? 100% because it's a sole shareholder. So this shareholder will receive how much cash? Let me ask you that. How much cash will the shareholder receive? It will receive the 5 million rands contributed tax capital, plus it will receive the 3.5 million rands, but less the 700,000 rands. So 2.8 million rands. So this person in total will receive 7.8 million rands in cash. I'm pointing it out to you. I want you to be aware of that. What are we going to use though for tax? First up, what we'll do is we'll say, okay, how much dividend did this person receive? And guys, just to show you what we're looking at now, is we're looking at this, the shareholder's perspective. The dividend amount is included in gross income and it is then exempt. So how much is our dividend amount? 3.5 million. Remember, the amount before the dividends tax always. That full amount is then exempt. So we are looking at the natural person shareholder. Right, so that's this first part over here that we've done. The next part that we now do is the contributed tax capital part. Now remember, paragraph 77 tells us that you must treat it as if the shares were sold. Okay? In this case, is this shareholder a share dealer or investor? He's an investor because he purchased it a long time ago. There's nothing that indicates it is in the production of income. So the investor will use the proceeds on the disposal of the shares, the contributed tax capital for that amount. So what is the contributed tax capital, guys? 5 million rands. The question tells you the shareholder acquired the shares for 6 million rands from a third party. So watch now. Now it is our return of capital. And this is now, in this case, paragraph 77. Our proceeds is the amount of contributed tax capital. Our base cost is whatever the base cost was in the question, 6 million rands. Because remember, the amount of contributed tax capital is treated like a proceeds amount. This now gives us a capital loss. Now, the moment that you have a capital loss calculated from the disposal of shares, you have to consider paragraph 19. In this case, we have to consider paragraph 19.1a because it is a liquidation, and it says to you you must identify the exempt dividend. And the exempt dividend is 100% exempt from two amounts, income tax and from dividends tax. Now, let's quickly talk about it. Here's the dividend, the income tax implication. Can you see it's 100% exempt? Yes, it is. Was there any dividends tax paid though? Yes, there was. So it's not 100% exempt. So our exempt dividend amount in this case is null. I'm going to write here, only allow portion that exceeds the exempt dividend. And what is our exempt dividend? Null. So how much of the million rands, don't say it's negative millions as less than null, how much of the lost million exceeds null? The full amount exceeds null rands. So that full amount will go into my CGT column. Okay, that is when, I'm going to take you back, the shareholder is a natural person. Now, what happens if the shareholder is a company? Okay, so first we go back to this calculation. If the shareholder is a company, this dividends tax there will not apply. There's no dividends tax. Okay, let me just ignore this for now. Clean it up. There's no dividends tax. Okay, so let's go through the process now. First up will be the dividend received. So it's still 3.5 million rands, fully exempt. Then is the return of capital. The proceeds is the CTC column, remember, in our calculation. So it's 5 million rands, so that's still the same. The base cost is still 6 million, which is a million rands loss. However, now, let's look at our exempt dividend situation here. Was it 100% exempt from income tax? Yes. Was it 100% exempt from dividends tax? Yes, because it's a company. So, thus, our exempt dividend equals 3.5 million rands. Now we say we only allow the portion that exceeds the exempt dividend. And how much is that exempt dividend? That exempt dividend is 3.5 million rands. How much of the million exceeds the 3.5 million? Nothing. So no portion will be allowed to be claimed as a loss. All right, that's it. Now we'll look at example 1.2.